Multifamily real estate got its ass kicked from 2023 through last year. That's 2025. We're recording this episode at the beginning of 2026. I can speak from experience, and it's been challenging, man. It's been a challenging asset. Emotionally, it makes me hate it with all my heart and all my soul. But I think there's a bright spot perhaps in 2026. What do you guys think? There's some data backing this stuff up too.
Look, I actually like multifamily, even though I had one bad experience with one property in one area that happens to be multifamily. I don't want to speak to multifamily in this like broad stroke that multifamily sucks, because multifamily has served me well. I started in small multifamily, 2 to 10 unit type stuff, with really the investment philosophy of like, I don't care about the price of the property as long as it cash flows. So I think the challenge, or at least the conversation, I think that we should be having, when we look at 23 to 26, a lot of investors, so-called investors, bought property with slim margins, and the so-called value add was, rents had to go up forever and values had to go up forever. And then you factor in these syndicators that were buying on slim margins that had to return capital to their investors, and they couldn't because the margins were so slim, and values and rents just don't go up always and forever. Over time, yes, but I don't want to speak in a broad stroke of like all multifamily sucks, because multifamily has served you well. If you buy on fundamentals like we talk about, and you're buying for cash flow, and you're not putting yourself in a position where you have to refi tomorrow, there's still a lot of opportunities in multifamily, and even through 2023 through to recent times.
Yeah.
You're like, oh shit, this isn't where I thought he was going. This isn't where I thought he was going. I thought he was going to badmouth multifamily, and we were all going to be on the same team and sing Kumbaya and hold hands
No,
walking down
I
the real
want to
estate
badmouth
alleyway.
multifamily.
He doesn't like resistance, okay? You need to be a loyalist to Travis.
I hate multifamily. I mean, it was when Mitch and I first started this journey, we had a couple rental properties. We started looking at multifamily, and I was the voice of reason. And I said, we should really look at these mobile home parks. I'm seeing 10 caps. I'm seeing better expense ratios. And Mitch fought me, but then finally realized that I was right. And now his life is forever changed.
Well, I just realized that because you hate multifamily because you're bad at it, because it's too complex and it's too much for your tiny little brain to get around. So when I partnered with you, I thought we got to do something really simple for this guy, or he's just going to absolutely ruin everything we have. So that's why we did MHP. It's simple, and Travis can.
I heard you guys say, hey, we were going to invest in multifamily. And then we heard Brandon Turner on Bigger Pockets say he's going to buy mobile home parks. So we jumped on his beardy bandwagon, and we're like, we're going to buy mobile home parks too.
We were doing it before Brandon. No, here's the deal here's kind of going what you're saying, Gabe. The multifamily properties you purchase, and I agree, it is location specific, et cetera, et cetera. And I own a little sixplex here in my local town too that's doing well. I would argue, though, that the multifamily that you own that's doing well, you bought on sound fundamentals with different economics in a different era. Like, I guess the question is, would you buy multifamily now? Would you go out and buy, if someone gave you a nice B-class property in a good market, they're telling you it was a 45% expense ratio, you've got maybe good agency debt on it, like, would you buy it now? Or would you, because I would argue for people that are wanting to start their journey, that might be something the economics are different.
Here's what I would do. I would buy multifamily if I got good terms. So if I got a great seller finance terms, and it was a property that was poorly managed, under rented, and I bought on fundamentals, meaning that when I bought today, if I bought a multifamily property today, and the financing that I put in place today supported the property as is, yes. The problem is, like, people get all high on hopium that rents are going to go up forever, or they look at a property and go, okay, I'm gonna overpay, or I'm gonna pay, let's say, $4 million for this multifamily property. It's worth $4 million. Rents are at $1,000 a unit. I think rents should be $1,500, but they don't actually fucking know. And then they buy it, and from day one, it's completely backwards. And then all of a sudden, their expenses are much higher. CapEx, there's all this CapEx stuff. There's turnover. There's, and that's where I think where people get hurt, is they're not looking at the deal like, not only how is it functioning today, but how has it been functioning the last 3 years? And the reality that prices Yes, over time, real estate goes up in value, but it's not always 20% year over year over year. And rents don't always, follow that same line either. So I think it's being realistic to, what is the property worth? What kind of terms can you get today? And do those terms support the property as is on the day you buy it? I think that's how you mitigate risk. You buy properties that make fundamental sense today, whether it's multifamily, mobile home parks. Yeah, I do think there's a lot of advantage in the mobile home park space because you own the land. If tenants own the homes, you're not dealing with a lot of this capex and maintenance and repairs and all these unknown expenses that maybe the seller lied to you about. So I don't know, but that said, there's opportunity in every asset class. Like I don't think you'll ever hear me not say that.
Well, Ken McElroy talked about the cycles of multifamily, and I thought that was an interesting podcast. If you haven't listened to that, by the way, go back and listen to Ken because he's like one of the godfathers of multifamily. At least I consider it. Pretty amazing guy. But like when I look at this market, I look at multifamily as a whole, and I'm kind of talking broadly national. We went through this time of high interest rates to combat inflation. Well, inside of that, it makes it harder for investors to go out and buy properties. It also makes it harder for people to have inventory. Building loans are really expensive, right? The cost of capital is high. So new inventory kind of freezes, not to mention high inflation increases the expenses of a multifamily property. So multifamily has gone through a storm. Now what's interesting though is supply has fallen off. New builds permits are down because the cost of capital is really high. What I'm saying though is supply falls off, new builds are not coming online, but now interest rates are falling. They've fallen whatever, a point and a half or whatever that is. Now we have a new Fed chair. We might see that also change things or interest rates go down. Maybe people are saying that could the interest rates could go down further, and now demand spikes. So new builders come into the market and new buyers come into the market, and then absorption happens. The problem though is it takes a while to pull permits and build new supply. So we could see a supply shock. In other words, a supply issue, which means rents start to go back up again because it takes time for people to bring new inventory online. And I think this is what Ken was talking about. He's like, look, if you got multifamily, hold, because yeah, it doesn't look great right now, but once interest rates go down, we're going to see absorption. We're going to see a supply issue.
Yeah, I mean, we are, the data does show that vacancy rates are stabilizing around 4.9 to 5.4%. And this is, to your point, Mitch, supply is sharply declining. New deliveries expected to drop significantly around 300,000 to 450,000 units in 2026, which is half the recent peaks and well below long-term averages. And and construction starts are already down. So to back your point, you still have an affordable housing crisis in this country. You still have people that need housing. That's not changing. That's actually getting worse. The supply of affordable housing, perhaps in multifamily, is sharply declining. It's also location specific. Anytime you read data like this, or you see headlines like this, I'd be like, hell yeah, like Austin might be an actual good place to invest because I think you have still a lot of supply or a lot of demand for affordable housing, but supply is going to be absorbed, and then it could be, but prices are way down there. So it isn't just a location, it is location specific. You got Midwest. Gabe and I own stuff in Oklahoma City, which there was never any oversupply. And there's still a lack, there was nothing going on there. I look at Oklahoma City much like a Midwest market, which is sort of steady Eddie, although it's tied to the oil and gas. I don't know, man. I mean, it's just, and Mitch points this out all the time. When someone says I have an apartment building that has $100,000 in net operating income, you're like, bullshit. It kind of doesn't, because at $100,000, it gets eaten up with CapEx. Insurance rates have 4x'd. It has been a brutal market. I don't know if multifamily is a good cash flow play. Maybe it's a good get in, reposition, exit play, but I don't know if it's a good long-term cash play. I'm super dupe.
If you like what you're hearing so far and you are not making at least $120,000 a year with cash flow real estate or have millions of dollars in equity, come check out our 0 to 100 elite community. The link is below. Check it out. It's property specific. Look, multifamily's kind of been the darling of real estate investing for years. And, people were able to win in multifamily pretty much anywhere in the country, big, small, medium-sized multifamily. There's multiple challenges here. For one, people, like as I mentioned before, they weren't buying on fundamentals, but also, like, it was just financing was easy. It was easy to get bank financing. It was easy to raise capital. It was easy to finance these multifamily properties. And we went through a time where interest rates literally doubled. I mean, it was the fastest rate increase that we've ever seen in the history of the United States. And so, you have to remember when you're buying commercial properties, for those, younger, newer investors that are listening to our show, it's not like a single family home or an owner occupied home where you lock this rate in 30 years fixed. So part of the challenge or part of the problem with multifamily, oftentimes on commercial loans, those loans reset after 5 years. And so even when the property worked with the fundamentals that we talk about for those first 5 years, it's when that loan reset that now people are going, oh shit, I'm in this position that I have to refinance. Rates are double and the value isn't there. I wasn't able to get, even if you were able to get rents up, even if you're able to take care of the capex, rates doubled. And so now you're in a position of like having to find financing that supports the property, even though the financing supported it 5 years ago. Can I get financing today that supports the property today? And I think that's one of the biggest challenges in multifamily.
Yeah, well, I think that's why when you say buy on fundamentals, you got to buy for today, the right cash flow fundamentals and DSCR and all those things, but you have to have a margin of safety. In other words, there's got to be a built-in upside to weather an interest rate spike or an inflation spike, because multifamily it is more affected by inflation than other assets like storage units or MHP is not going to be affected the same because it doesn't have the same expenses. So when you buy today, you've got to build in a margin of safety. It's like Warren Buffett when he buys a stock, he's got a margin of safety. He understands what that is. And so you've got to understand that things don't always go your way. And that could be a 5 or 10-year cycle where interest rates are going the wrong way. They're going against you. Expenses are higher than you thought. And that's the thing, with MHP, we do that all the time. We say, well, what if interest rates go up to 8% or 9%? Because I don't know. Maybe interest rates go up from here. We don't know, right? We think they'll go down, but like you have to have that margin of safety or else you're caught with your pants down and it gets ugly.
I also want to illustrate something that, I don't want to fall victim to the same advice that I give other people is like, just because somebody had a bad experience in multifamily, it doesn't mean that all multifamily sucks. It doesn't mean they should stop. I mean, I think about, we have a family member, they bought a single family home, they fixed it all up, they over improved the property, first of all, just because they had a fine sense for design. They put all this money into it. They had one bad tenant and they were like, screw this, I'm never investing in real estate again. And it's like, well, like that's kind of a crazy take. And you could do that in multifamily too. And just because I personally or Travis, you had a bad experience, in Oklahoma City, and these have been challenging properties, I don't want to say, hey, all multifamily sucks, because long term, I do believe in multifamily real estate. I mean, I think that there's probably more multifamily real estate outside of maybe, single family homes that house people. Like these are apartments that people live in, and there's, millions of them throughout the entire country. And there's going to be a place for multifamily. And I think one piece that we forget about too is like owning more real estate. And this is the piece, like owning more real estate puts you in a better position. You hear me say it all the time. It gives you optionality, right? Because I own real estate, because you guys own real estate, because our listeners own real estate, when you have those times when, say multifamily's down, if your other properties can help support those downturns in a certain asset class, you're in a better position to take care of those properties, and so to me, it's no different than, you own one single family house, it goes vacant, or, the tenant destroys it. That's 100% of your income. It's no different than, you own 100 units and one tenant, one unit goes vacant. It's 1/100th of your units. And so in a lot of ways, I guess in a lot of words, I'm just trying to say owning more real estate is actually less risky, in my opinion, than owning just a little bit of real estate.
Yeah, and I would always choose a multifamily property. I think it's also, and also saying multifamily is a broad stroke. There's class A, B, C, there's D, there's heavy value add, there's workforce housing, there's LIHTC, there's Section 8. There's all kinds of different asset classes out there. I think now if I'm looking at multifamily as a business strategy, I'm looking at markets that maybe are undervalued, like maybe some of the Texas markets that took a beating. Like maybe you can pick these properties up on high cap rates. There's still the demand fundamentals. There's still the income of your tenants. I would definitely not go Class C. Personally, I would go Class B, maybe in a Class A neighborhood. I would reposition it. I also just can't help but wondering if multifamily will continue to work. In my mind, the only way multifamily continues to work is rents have to keep going up because the cost of materials have gone up, the cost of the trades and labor have gone up. Insurance rates have skyrocketed 4x in some markets. Interest rates vary, yes, but interest rates don't necessarily have a direct correlation to some of those other costs. So I guess the question is, can rents continue to go up to support the expense load and the capex and actually make it a viable investment? I think there's certain markets and certain asset class subclasses of multifamily that don't work because how do rents keep going up? How do you eventually rents are going to have to be $4,000 a unit to be able to support the expense load and the capex.
And they will be. I think that like the reason rents go up is we have a government that prints capital. Both sides do it, and they deflate the value of the dollar. And we actually, as real estate investors, we make money on inflation. And so now in the short term, it hurts, especially multifamily, because your expense line grows really, really fast. But if inflation remains in that 2 to 3% rate, which is kind of been the traditional sort of Fed target, then I think multifamily works fine because the expense lines grow by 3%, but the expense is less than the revenue. The revenue grows by 3% and you actually make money on inflation. But when you see inflation go 8 to 9% for a couple of years, that's where I think people get really squeezed. The Fed needs to keep inflation in check. I mean, that's the truth. Otherwise, everything's manipulated and things go backwards. So I think over time that this will stabilize and rents will start to catch up and they'll be to a point where people are making a profit. But in the short term, multifamily owners got hosed by, I think the number one thing is high inflation. And then as a result of that, high interest rates.
Well, and these large institutional players are coming back into the market. Cash flows are coming back in. There's institutional buyers. There's institutional lenders. I know for a fact that agency debt on, I have a 150 unit property has been touch and go. I'm still working on a refinance there. So, I mean, they see stuff that we don't see, right? They have analysts, they have trained PhDs that are working on this stuff. And they do see these institutional players do see an opportunity to multifamily. I guess the question is, how can our listeners who might be at a couple of single family houses or maybe just, they're just getting started, how can they win in multifamily? If someone was to say, hey, Gabe, hey, Mitch, I'm just getting started. Multifamily is my asset class of choice. I'm not going to listen to all of your rantings about the wonders of mobile home parks and triple net industrial. I want to go multifamily. If you were to sum it up in sort of just a bullet list, a punch list, how could someone succeed in multifamily as they're getting started now?
I'll speak to that quickly. Go out and find problems. Go solve a problem for a seller, and go find big problems. Go find problems where buildings have been, they're outdated, they're dilapidated. Potentially, there's repairs that needs to be made. Could be a lot of repairs. Could be a couple $100,000 in repairs for, systems, roofs, health and welfare, aesthetics, amenities, that kind of stuff. Go find those issues. Go find buildings where rents have not kept up as a result of the condition of the building. Work your math and understand the upside, understand the initial investment, and understand what it's going to take, the timeline of investment, the scope of work, and then where you can move rents. Most tenants are going to love you for it, even if rents go up $100 or $200, because you're improving their lives. You've got to be a problem solver, I think, in this market. And in multifamily, we've seen a lot of problems. And because of that, I think there's a lot of opportunities. Now, with that, you probably need to go off market mostly. Most of the time, you're not going to find it on a LoopNet or a Crexi. That's a great place to analyze properties and meet brokers. But I think you need to go off market and you need to look for big problems and go be a problem solver. And that's the beautiful thing about this whole thing and about capitalism is we can go out and make a profit by solving problems, by improving tenant lives, improving buildings, and improving the whole community. That's my 30-second take.
Yeah, no, I think it's well said, and I would similarly say, solve problems. And I think a big problem is just tired landlords. I go back to 2009 through 13 when I picked up the majority of my seller finance portfolio, and it was all smaller multifamily, 2 to 10 unit type stuff. But this is following 2008, and so you had a lot of these mom and pop owners that were scared, but they weren't just scared of like where prices were going to go. They were tired landlords. They'd been self-managing. They had been dealing with tenants and repairs. And so they actually just wanted an annuity stream. Good people, great people. They had built up a significant level of wealth by owning real estate. And oftentimes they'd owned this real estate for 30 plus years. And they just wanted income, and they were uncertain of where the market was, right? Or where it was going. And so it was tired landlords. So to Mitch's point, it's solving a problem. Their problem is, hey, we don't want this big tax load. Like I don't want to sell this in a down market. I don't want to, pay capital gains if I sell it. I don't want to actively invest. I'll be the bank. So good people. And you're to Mitch's point, you're solving a problem. They want an annuity. They want an income stream every month, and you're there to negotiate terms. And so if you can solve that problem for a potential seller and you're willing to get creative, and I'll say this time and time again, in this market, the more creative you can be, the more you're going to win. And it's not you winning and them losing. A seller finance deal, creating that opportunity for you as a buyer and for the seller is a win-win scenario. And I think that's who wins in this market, is those willing to be creative. You solve their problem, and you, at the end of the day, you own more real estate and they have income.
Yeah, I'm a big believer in social capitalism. Tenants need to win, the sellers need to win, the buyers need to win, the banks need to win if they're involved. I think the last piece of I would give advice to on people pursuing multifamily, or really any real estate asset for that matter, is we say this all the time to our elites in the 0 to 100 mastermind. Don't try and make a deal work in a spreadsheet. Be conservative, take the emotions out of it. Be conservative on your underwriting. If you think it's going to be a 40% expense ratio, mark it up to a 50% expense ratio. If you think your vacancies are going to be 5%, mark them down, mark them up to 10%. And also come in well capitalized. With multifamily, you damn well better have a nice reserve cushion. You need to be ready for the roof. I mean, obviously do your due diligence, make sure you've got good sewer line infrastructure, you've got good roofs, you've got good systems. In addition to that, come in well capitalized to weather rainy days. And I think you could win that way.